Topic focuses on the importance of credit risk policies in maintaining the safety and soundness of financial institutions. Credit risk policies establish the principles, standards, and procedures governing lending activities and risk-taking decisions. These policies define acceptable risk levels, approval authorities, exposure limits, collateral requirements, and portfolio diversification standards. Effective credit policies ensure consistency in credit evaluation and reduce the likelihood of excessive or poorly controlled lending. Financial institutions rely on these frameworks to align lending activities with strategic objectives and regulatory requirements. Clear policies also support accountability among lending officers and management while promoting prudent risk management practices across all credit-related operations. The topic further explains the concept of credit asset classification, which is used to evaluate the quality of loans and other credit exposures. Financial institutions classify assets according to the borrower's repayment capacity, financial condition, and probability of default. Common classifications include performing, special mention, substandard, doubtful, and loss categories. Performing assets generate expected payments without significant concern, while classified assets exhibit increasing signs of financial weakness or repayment difficulties. Asset classification helps institutions identify deteriorating exposures early and implement corrective actions. Regulators also rely on these classifications to assess the financial health of banks and determine whether sufficient capital and reserves are maintained against potential losses. A key principle is the need for ongoing credit monitoring and periodic review of classified assets. Borrower conditions can change rapidly due to economic downturns, industry disruptions, rising interest rates, or operational failures. Institutions therefore conduct regular credit reviews to reassess borrower financial performance, collateral values, and repayment capacity. Early warning indicators, such as declining cash flows, covenant breaches, or delayed payments, help identify loans at risk of deterioration. Effective monitoring enables institutions to restructure loans, increase provisions, or reduce exposures before losses become severe. Strong classification systems improve transparency, support risk reporting, and strengthen the institution's overall credit risk management framework. Topic examines loan loss provisioning, which refers to the process of recognizing expected credit losses in financial statements. Loan loss provisions represent expenses set aside to absorb potential losses from borrowers who may fail to repay their obligations. Provisioning is essential because it ensures that financial statements accurately reflect the economic value of credit portfolios and the risks associated with lending activities. Institutions estimate expected losses using historical default experience, borrower credit quality, collateral values, and macroeconomic conditions. Adequate provisioning protects capital, supports financial stability, and increases investor confidence. Insufficient provisions, however, can overstate profitability and weaken an institution's ability to absorb future credit losses. The topic also discusses different approaches to credit risk assessment and expected loss estimation. Traditional methods relied primarily on incurred loss models, where provisions were recognized only after evidence of impairment emerged. Modern accounting standards increasingly emphasize expected credit loss models that require earlier recognition of potential losses based on forward-looking information. Credit risk assessment therefore incorporates probability of default, exposure at default, and loss given default to estimate anticipated losses more accurately. Institutions use internal rating systems, stress testing, and scenario analysis to evaluate portfolio vulnerability under changing economic conditions. These methodologies improve risk sensitivity and encourage more proactive management of deteriorating credit exposures. Finally, topics emphasize the critical relationship between sound credit policies, asset classification, provisioning, and financial stability. Effective credit risk management depends on accurate identification of problem assets and timely recognition of expected losses. Regulatory frameworks require institutions to maintain transparent classification systems and sufficient loan loss reserves to protect depositors and maintain confidence in the banking system. Poor credit assessment practices and delayed provisioning have historically contributed to banking crises and systemic instability. By implementing strong credit policies, rigorous monitoring processes, and robust provisioning methodologies, financial institutions can improve portfolio quality, strengthen resilience during economic downturns, and support sustainable long-term profitability.